Hi, my name's Eric. I'll be reading you selections from this week's Barron's magazine with an issue date of April 13th of 2026. It's produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We start with the Streetwise column. The stories behind the market's 10 cheapest stocks by Jack Huff. The cheapest stocks in America is up 520% in a year. Those are two things that shouldn't go together. It's like saying that the smelliest dog in town got 4 baths this week. How is it still the smelliest? The answer has to do with artificial intelligence. I mean for the stock, not the dog. It's one of the few things that stand out from a recent screen for the 10 lowest forward price-to-earnings ratios in the S&P 500 index. This is a semi-regular act of morbid curiosity, not a sound investment strategy, but the numbers aren't helping to prove my point. Had you pulled up the 10 lowest P/E stocks a year ago and put equal dollar amounts in each, you'd have made 70% with dividends, trouncing the S&P 500 by 49 points. If you had done so 2 years ago, you would have outperformed by 9 points. 5 years ago, and you're ahead by 73 points, and 10 years, more than 300 points. I'm pretty sure that's a fluke. The P/E is way too simplistic to be a reliable signal of value. For that, we need a team of business school graduates with spreadsheets modeling at least 10 years of hypothetical business results, and then layering on concepts that are both mathematically sound and totally made up, like weighted average cost of capital, terminal value, and risk adjustment. Only then can we calculate a fair present value. I live within the gravitational pull of New York City, and my property value is riding on the continued prosperity of these spreadsheet people, so let's not pretend that we can spot cheap stocks ourselves. But let me run quickly through the list just the same with a few observations. At the end, I'll guess which of these stocks will do the best over the coming year. I have reliably poor instincts about that sort of thing, so this will be a valuable contrarian signal, and you're welcome in advance. Micron Technology has the lowest price-to-earnings ratio on the list, just 4.4 versus 20.5 for the S&P 500. Companies that end up on this list typically have an underperforming P. But this one has had an outrageously rising E. The company has never earned more than $12 a share. But earnings are now pegged at $56.74 a share for the fiscal year through August and $93.24 next year versus $8.29 last year. Micron makes memory, which is in fierce demand for AI data centers, leading to shortages and soaring prices. Cue lion eyes by the Eagles. Investors who've seen past memory booms fizzle are wary about this one. So the stock hasn't climbed as quickly as the earnings have. By the way, the AI spending rush has done something similar for hard drive maker Western Digital, which isn't on this list but was on it a decade ago. Its return of more than 1,000% since then is one reason that the lowest P/E'ers thumped the market over that stretch. Another reason is a company called United Rentals, which has cashed in on a trend toward companies borrowing, rather than buying, construction equipment. It too has returned more than 1,000% in a decade and is no longer close to making the lowest P/E list. General Motors, 6.2 times earnings, is no stranger to this list, but it has also returned 68% over the past year and 127% over the past 3, easily beating the market. It's generating heaps of free cash by focusing on pricey trucks and sport utility vehicles. On a somewhat related note, Delta Airlines and United Airlines, which would have easily made this list a decade ago, have since graduated off it and are weathering a spike in fuel prices well. Global Payments, 4.7 times earnings, and Fiserv, 7 times, are heavily indebted players in a decidedly unsexy part of financial technology, processing card payments for merchants. Prudential Financial, 6.9 times earnings, and Everest Group, 6.3 times, are insurance and reinsurance companies that can have lumpy earnings. Prudential's 5.8% dividend yield is the highest on the list. Cable companies have been losing their pay television subscribers to streaming for years. Increasingly, telecom is coming for their cable broadband customers too, with faster fiber optic service. Those trends have left Charter Communications at just 5.2 times earnings. Gen Digital, 6.8 times earnings, is a mashup of Avast and Norton LifeLock, players in home cybersecurity. It's growing, but also heavily indebted. The stock enjoyed little of the past decade's run-up in shares of enterprise cyber giants like Palo Alto Networks and CrowdStrike Holdings, but has participated in all of the recent downside on AI disruption fears. AES, 5.9 times earnings, is a debt-heavy utility that recently agreed to a buyout by BlackRock's global infrastructure partners and others. That leaves Viatris, 5.6 times earnings. It might as well have been named Hate Sponge when it began trading in November 2020. There was a company called Mylan, which was best known for buying EpiPen, the life-saving injector for severe allergic reactions, especially for kids, and then multiplying the price 7-fold in under a decade. It merged with a part of Pfizer that owned off-patent former blockbuster drugs for cholesterol, impotence, arthritis, and depression. The idea was to use the cash flow to produce new, growing drugs while quietly letting the EpiPen thing fade from memory. I think it's working. My disgust feels like it's down at least 40% from 2020, and I noticed that Viatris's earnings per share are expected to grow slightly this year for the first time since then, although the estimate has been slipping, so let's see. Viatris is my top pick from this group. If it outperforms in the year ahead, I'll gloat. If it tanks, I'll have jinxed it on behalf of all those EpiPen overpayers from the mid-2010s. I figure I can't lose. From Up and Down Wall Street by Andy Serwer, the headline reads, AI agent OpenClaw will do your trades. Should you try it? I came for the lobster and stayed for the covered calls. If a crustacean and options trading mashup has you vexed, understand that I'm talking about OpenClaw, the red-hot artificial intelligence agent that some hardy souls are using to manage their investments these days. And yes, it was OpenClaw's lobster motif that first caught my eye. Unlike chatbots such as ChatGPT, so 2025, OpenClaw can proactively execute your tasks, like make appointments or buy tickets to a show. It can also advise you on investment strategies and even trade securities while you're sitting on a beach. What could possibly go wrong? My point isn't that OpenClaw is the second coming. It's that AI is coming, or rather, is already here and increasingly used by Wall Street institutions and individuals alike. I'm not suggesting that you should join this clam bake, but it might behoove you to understand what's going on. OpenClaw, which was created last November by Austrian vibe coder Peter Steinberger, who now works for OpenAI, reportedly had 38 million monthly users, many in China, sloshing around its lobster nomenclatured ecosystem. Discord's OpenClaw channel, Friends of the Crustacean, is a flurry of often deeply technical activity. My handle is Andre the Seal. To get a beat on this, I spoke with Thomas Petterfee, chairman of Interactive Brokers Group, who's long been on the bleeding edge of financial technology. Petterfee, who's 81, also happens to be the wealthiest man on Wall Street. in no small part because Interactive Brokers shares have climbed from $16 to $72 since April of 2022. I started this business as a computer programmer, so I've always been building algorithms, he says. We've given algorithms to clients for many years, and they automatically execute orders. AI is just like a new, even higher level computer language, and we're big users. Certainly it's the future. Interactive Brokers customers use AI either through external agents like OpenClaw or through the brokerage's internal tools provided by partner company Reflexivity. The problem was never a shortage of data. It was that it would take days to work through. Now it's like 8 minutes, says Jan Zalagi, CEO and co-founder of Reflexivity, a Harvard University PhD in economics and finance who once helped manage global macro portfolios for Stan Druckenmiller. On Wednesday morning, with the market roaring over the announcement of a 2-week ceasefire between the U.S. and Iran, I asked Szilagyi to help me pick up a post-TACO trade. TACO, of course, stands for Trump Always Chickens Out. The algo came back with an 11-page report concluding that first-day TACO trades worked too well in capital letters and suggested, with entry points, strong long positions in crude oil and the CBOE Volatility Index, or VIX, a moderate long on the State Street Energy Select Sector SPDR exchange-traded fund, a moderate short on the S&P 500 index, and a weak short on treasuries. Interactive scrutinizes customers using external tools like OpenClaw. We have a program to catch orders they send and examine them within a fraction of a second to ensure they comply with regulations and applicable margins, says Petterfy. What if OpenClaw sells my stocks against my wishes? Well, that's not my problem, he says. That's your problem. We just check the orders and execute. That problem might be closer to home over at upstart stock trading platform Public.com, which has gone whole hog, or is it whole shellfish, into AI. Public's customers can connect OpenClaw directly to their accounts to analyze and, yes, trade securities. Privately held and venture-backed by Excel and Tiger Global, New York-based Public has billions in assets under management and millions of customers, according to Janek Malling, Public's Danish-born co-founder and co-CEO. Public began exploring AI in 2023 to create the world's first agentic brokerage, he says. OpenClaw is bringing that endeavor to a boil. Trading went from phone-based to the web to mobile apps and now to agentic AI, says Malling. That you can just type in, find me 3 different ways to make 10 grand this month selling covered calls across my portfolio, is a massive shift. Setting up OpenClaw requires digital elbow grease. It took me 1.5 to 2 hours to set it up, says Dean Ahrens, a 19-year-old trader from Westminster, Colorado, who typifies the customers Public is looking to net. Ahrens recently used OpenClaw to build and execute a put option strategy on the Invesco QQQ Trust ETF, and to help find and buy puts on Hims and Hers Health. On the institutional side, Cliff Asness, who runs giant quant hedge fund AQR, was once cynical about AI. I probably slowed us down a couple of years on this, he says, which is rational when you have something that's worked for 30 years. All these decisions involve dollars, time, and risk. Asness, 59, who notes analysts at his funds have been sifting through credit card data and positive and negative words in earnings statements for decades, became a convert. It turns out machine learning, a subset of AI, is better than our old methods, he says. Historically, AQR's positions were built conceptually 50% on historical data and 50% on economic story, as Ness says. Now, because of AI, it's more like 2/3 data, 1/3 story. Have AQR's returns improved? Well, it's been a good 5 years, he says. as Ness is less sanguine about AI for retail investors. I'm leery about a world where machine learning is on everyone's lips. This notion that you can pick just a few stocks with it may not be worse than any other method, but I don't see any magic there. When it comes to OpenClaw, bon appetit. Just don't get pinched. And now a look back into what happened this past week and what's to happen this coming week from the review and preview section of Barron's for April 13th. Big yachts, big bucks. Despite tariffs and wars, the $13.8 billion superyacht business is cruising. Last year, 360 pre-owned superyachts of at least 30 meters, that's nearly 100 feet, sold for $6.4 billion, up 36% from 2024, notes Fraser Yachts in its 2026 Global Superyacht Report. Another 211 new superyachts were sold, up from 199 a year ago, with 19 over 260 feet, compared with 13 in 2024. In all, the superyacht world includes over 6,200 vessels, up from 4,550 a decade ago. Still, sales trail 2021's pandemic peak when 497 pre-owned and 319 new vessels were sold. Post-pandemic sales dipped and then rebounded. They could rise more, says Fraser CEO Anders Kerten, if more big boats, 200 to 230 feet, were on the market. Last year, Breakthrough, a 390-foot yacht powered by hydrogen fuel cells, sold for $793 million. Tops among new yachts, says Fraser. The largest vessel sold last year, at 446 feet, was Flying Fox, which Luxury Launches reported was bought by a member of the Abu Dhabi royal family. Among new boats, the trend is toward larger, highly bespoke builds, says Fraser, with average length rising to 159 feet. One trend is sustainability. Power sources like fuel cells are now more feasible. Curtain points to diesel-powered yachts less than 20 years old that can slash emissions by converting to hydro-treated vegetable oils. And then there's wind. Amazon.com founder Jeff Bezos' 410-foot sailing yacht, Kourou, estimated cost $500 million, remains an outlier. Only 14% of super yachts for sale feature sails. That was reported by Abby Schultz. Last week in markets, investors began the week trying to interpret President Donald Trump's latest Iran deadline, which involved bombing power plants and bridges. Stocks were volatile but finished up. And then came Tuesday. In the morning, Trump threatened to destroy Iranian civilization, and in the evening he declared a 2-week ceasefire. Oil fell the most in 6 years, and stocks surged, even as disagreements over terms mounted in the run-up to talks that started on Friday. March inflation hit a hot 3.3%. On the week, the Dow Industrials rose 3%, the S&P 500 3.6%, and the Nasdaq Composite 4.7%. Companies last week. In his annual letter, J.P. Morgan Chase CEO Jamie Dimon warned of weakening lending standards. Moody's downgraded a Blue Owl Capital Fund. Medicare announced it would pay Medicare Advantage plans 2.48% more in 2027. Anthropic previewed a cybersecurity model with select companies, including Microsoft, Apple, and Amazon.com. Treasury held a meeting with bank heads to discuss it. Casey's General Stores replaced Hologic, which was bought out by Blackstone and TPG in the S&P 500. And Artemis II neared Earth after a record-breaking trip around the moon. In deals last week, Bill Ackman's Pershing Square Capital made a bill for Universal Music, valuing it at some $60 billion. The complex plan would merge Universal with a blank check company, Pershing Square Spark Holdings, which would list in the U.S. And Gilead Sciences agreed to buy German biotech Tubulis for up to $5 billion in cash. This week on Monday, April 13th, first quarter earnings season kicks off with results from the big banks. Goldman Sachs Group releases quarterly results Monday, followed by Citigroup, JP Morgan Chase, and Wells Fargo on Tuesday. Bank of America and Morgan Stanley announce earnings on Wednesday, and Charles Schwab and U.S. Bancorp follow suit on Thursday. Outside of the financial sector, Johnson & Johnson reports results on Tuesday, while Abbott Laboratories, Netflix, and PepsiCo do the same on Thursday. On Tuesday, April 14th, the Bureau of Labor Statistics releases the Producer Price Index for March. Consensus estimate is for a 4.6% year-over-year increase, 1.2 percentage points more than in February. The core PPI, which excludes volatile food and energy prices, is expected to rise 4.1%, compared with 3.9% previously. On Wednesday, April 15th, the Federal Reserve releases the Beige Book for the third of 8 times this year. The report gathers anecdotal information on current economic conditions from the Fed's 12 regional banks. Wednesday is the deadline to file tax returns and pay any taxes that are due for 2025. By the numbers, $172 billion. That's the value of private equity acquisitions in the first quarter, down 36% from the previous quarter. 61.9%, the percentage of Americans working or seeking work. That's the lowest since 1977, not including the pandemic. $65 billion. How much OpenAI and Anthropic will spend this year to train and operate their models, more than their revenue. 53.1 is the number of U.S. births per 1,000 in 2025, a record low as birth rates shifted to women in their late 30s. On to the next article, which reads, Bank earnings look good despite worries. Big lenders report this week after their shares have struggled. 2 concerns, private credit and war, by Rebecca Ungarino. Call it a stretch to forget. The KBW Nasdaq Bank Index fell 6% in the first quarter for its worst performance since 2023, as the Trump administration's war on Iran rattled investors. Still, you wouldn't know it by looking at rosy expectations for earnings growth. Quarterly report cards from America's largest banks, which are due this week, are expected to show profits climbed in the first quarter from a year ago, helped by strong investment banking and trading activity. Goldman Sachs reports Monday, followed by JP Morgan Chase, Citigroup, and Wells Fargo the next day. Morgan Stanley and Bank of America are up on Wednesday. If investors are heading into this marathon of filings and conference calls with questions, most important is probably the one posed by UBS analyst Erika Najarian in an April 7th note to clients. Can solid results overcome a wall of worry? The answer, it seems, is yes. The market's been dealing with a plethora of largely negative headlines, Najarian wrote. But even after reducing our presumed rate cuts from 2 to 1 in September, our estimates for 26 and 27 are largely unchanged. Investors scour bank results because they serve as windows into the economy. Consumer lenders provide data on individual borrowers' credit quality and spending, while investment banks' performance shows corporate clients' confidence in deal-making and raising capital. For several quarters, banks' results have reflected bumper performance for core Wall Street businesses and solid, but not as ebullient, showings for everyday consumers. Bank CEOs have recently noted, too, that they're seeing a divergence in financial health between high and lower income clients. What is left unsaid can also reflect banks' backdrop. They may be reluctant to raise expectations for their full-year performance because of macroeconomic uncertainty, wrote B of A securities analyst Ebrahim Poonawalla on April 6th. Still, a busy quarter for trading desks and bankers, paired with a decent setup for net interest income, should drive solid results, he added. Beyond evaluating big banks on the usual profitability measures, shareholders will look for updates on one of the market's most pressing concerns: private credit, the bank's less regulated, less transparent, troubled cousin. Investors worry that banks are overexposed to private credit players that are now coming under stress. Banks have lent billions of dollars to private credit funds. Those funds, in turn, lent money to, among other sectors, software providers, now facing intense competition from artificial intelligence. Fears that those businesses could suffer and default have fueled concerns of risk spreading throughout the financial system. Lending to private credit funds has soared, led by money centers as well as superregionals and regionals, wrote J.P. Morgan securities analyst Vivek Juneja on April 7th. Banks and private equity firms have generally disputed the notion that private credit threatens financial stability. But steep sell-offs in the software and alternative asset management sectors have spooked investors. Executives' remarks on private credit and credit quality broadly will come into focus. Management commentary at earnings will likely underscore that credit is strong today, but higher for longer oil prices would be a risk, wrote Morgan Stanley analyst Manan Gosalia on March 31st. We view bank lending to private credit as more of a headline risk than a fundamental risk. Wall Street's picking its winners. Citi's stock has become a favorite among sell-side analysts attracted to the bank's potential for higher returns after years of underperforming its rivals. Citi is the top choice for Wells Fargo banking analyst Mike Mayo and B of A Securities' Poonawalla. After quarterly earnings, the New York lender led by CEO Jane Fraser is set to hold an investor presentation on May 7th. We view Citi favorably, given its improving return profile driven by broad-based revenue growth, disciplined expense control, and rising capital returns, wrote Jefferies analyst David Chiaverini on April 8th. On her bank's earnings call, Fraser will probably field questions about a late March Bloomberg News report that said senior leaders there recently held early-stage discussions about acquiring a bank or other type of financial firm. Citi told Bloomberg that the suggestion is baseless speculation and that for now it is solely focused on organic growth. The bank referred Barron's to that statement. Investors may question Fraser over acquisition strategy in May. Earnings at J.P. Morgan Chase, the largest bank of the bunch, should benefit from strong results in its markets and investment banking business, wrote Piper Sandler analyst Scott Seifers on March 31st. For bank observers, parenthetically, J.P. Morgan Chase usually sets the tone for quarterly earnings as the first of the big banks to report. This quarter, though, Goldman Sachs is scheduled to go first. In his note, Seifers, like UBS's Najarian, lamented a wall of worry that banks face. Quarterly earnings should be strong, he wrote, but investors have plenty of anxiety, and that could make for an earnings season to remember. The next article, in Barron's of April 13th, this REIT owns trophy hotels. Shareholders aren't happy. The government here is just abysmal, one portfolio manager told Barron's. Is anybody looking out for the shareholders? By Bill Alpert. Monty Bennett's asset management firms have received $1.9 billion in payments from the two real estate investment trusts he runs, even as those REITs, real estate investment trusts, have lost most of their value. The management companies now say they're entitled to another $500 million if the more valuable of those REITs succeeds in selling a sufficient number of hotels. Braemar Hotels and Resorts owns 13 trophy properties, including the Ritz-Carlton Lake Tahoe and the Four Seasons Resort Scottsdale, with some of the highest room rates in the industry. It has a market capitalization of $175 million. Bennett's other REIT, Ashford Hospitality Trust, owns over 60 good-quality hotels, but has a stock market value of $19 million, and both REITs are heavily indebted. Under the 60-year-old Bennett's leadership, Ashford Hospitality shares are down 99.99% from their 2014 peak, while the FTSE Nareit Equity Lodging and Resort Index is down 18% in that time. Braemar shares have fallen over 90% since the company's 2013 debut, even though the REITs have made operating profits. Shareholder activists have tried unsuccessfully to loosen Bennett's control for a decade. In August, Braemar's board put Braemar up for sale. Its agreements with Bennett's management company, Ashford Inc., and his other firms provide termination fees of $505 million. Investors say that makes the REIT's sale impossible. The problem is basically all the proceeds go to Monty, says Gene Preddy, a portfolio manager at Zazovi Associates, which has owned Braemar's securities for several years. The governance here is just abysmal. Is anybody looking out for shareholders? The REIT's chairman doesn't apologize. The terms of the advisory agreement, including the termination fee, have been disclosed to and approved by shareholders, Bennett said in a statement to Barron's. Shareholders who acquired Braemar and Ashford Hospitality shares did so with full knowledge of their structure and its terms. The inability of successive activists to budge Bennett stems from the management-friendly laws of Maryland, where most REITs are domiciled. Outside shareholders can't own more than 10% of a REIT. When shareholders declined to re-elect Bennett and the REIT's lead independent director to the company's boards, the other directors reappointed them. The shareholders fire you, but no one cares, laments Alejandro Malbran, whose Brancas LP is the latest investment firm to try rallying Braemar's shareholders against Bennett's management. When activist shareholders have criticized Braemar's contract with Bennett, the REIT has sued them for violating securities laws and tortious interference. Braemar sued Malbran in Maryland's federal court in early March. Says Malbran, "If I ever try to do this again, just shoot me." Monty Bennett joined his father Archie's hotel business in 1989. Over the next few years, they teamed with investors, including George Soros, to become the largest buyers of hotel assets from the government-owned Resolution Trust Corp., as it liquidated mortgages from savings and loan failures. They brought their hotels public in 2003 as the Ashford Hospitality REIT. 10 years later, Ashford Hospitality spun out its best properties as a separate REIT, ultimately called Braemar. Bennett set out to build an asset management empire around his REITs. In 2014, Ashford Hospitality spun off most of its real estate advisory operation as a New York Stock Exchange-listed company called Ashford Inc. Bennett was chief executive and controlling shareholder of the new firm, which likened itself to asset management giants like Blackstone and Starwood. Ashford Inc. started off with decades-long contracts as the outside advisor to both REITs. It has provided day-to-day hotel management, raised capital, and even operated motorboats for the hotels. In its dozen years as a reporting company, securities filings show that it received a cumulative $1.9 billion in payments from the REITs and reported $330 million in adjusted earnings before interest, taxes, and depreciation. Bennett and his family did well under the arrangement. Since the 2013 spin-off of Braemar, Barron's calculates from proxy filings and annual reports that Bennett was awarded over $110 million in compensation pay, stock, and cash from the REITs and the Ashford Management Company, plus more than $70 million in declared dividends on his preferred shares. Bennett told Barron's that his compensation was substantially lower, quote unquote, and that our calculation of his dividends is absolutely wrong. But he didn't provide any numbers. Ashford also acquired Bennett family businesses that provide daily management, design, and construction for the hotels, paying with stock worth $475 million at the time. Ashford Inc. common stockholders, well, they fared less well. A hedge fund it launched in 2015 with $48 million from Braemar wound down the next year after substantial losses. Ashford Inc. never became the big manager of outside assets that it aspired to be. By the time Bennett took Ashford Inc. private again in 2024 for $11 million, its common shareholders had never had a profitable year after paying interest costs and preferred stock dividends. While running the REITs in Ashford Inc., Bennett attracted local attention outside the businesses. In a 6-year campaign to keep the Tarrant Regional Water District from running a pipeline across his 1,500-acre Lazy W Ranch in North Texas, Bennett moved a graveyard into its path, formed his own water district, and stocked his ranch with endangered species. He won. When the COVID pandemic emptied hotels in 2020, the properties furloughed 90% of their workers. Bennett made national news when his REITs turned out to be one of the biggest participants in the government's small business rescue effort, the Paycheck Protection Program. From a program whose average loans were around $200,000, the REITs sought approximately $126 million, as Senator Chuck Schumer, a Democrat from New York, complained in a letter to the U.S. Small Business Administration. After that publicity, Bennett's REITs returned the PPP funds. Bennett has used his REIT earnings to support politicians and causes in Texas. Most recently, he helped pass amendments to the Dallas City Charter that required the city to hire 900 additional police officers, put half of any new tax dollars toward police and fire pensions, and waived the city's sovereign immunity from citizen suits. When Barron's asked Bennett about the decline of Braemar's stock, he sent a statement blaming the REIT's troubles on government shutdowns during COVID and high interest rates that were set by the Federal Reserve. Government-mandated shutdowns effectively eliminated hotel revenue industry-wide for an extended period, Bennett said. Virtually every public hotel REIT saw dramatic declines in stock performance during and after the pandemic. In 2017, Braemar and its shareholders approved the contract that will award Ashford the $505 million termination fee if Bennett loses control of the REIT. Shareholders have challenged the related party contracts for a decade. When investor John Petrie of Sessa Capital attempted a proxy contest in 2016, Braemar's proxy solicitor warned Petrie that Monty Bennett would rain down a path of destruction on him, according to filings from a Dallas federal court suit in which Ashford sued Petrie for $200 million on allegations that he was tortiously interfering with its advisory contract. Petrie settled the suit. He didn't respond to Barron's queries. In 2023, the investment firm Blackwell's Capital, led by Jason Antaby, offered to take Braemar private for $4.50 a share, more than twice its then share price. Blackwell's financial analysis, which was disclosed in later litigation, estimated that Braemar's hotels could be worth $3.5 billion within 5 years. The analysis concluded that the REIT traded far below its net asset value because of what Antaby referred to as a Monty discount. In the ensuing proxy battle, Antaby found himself the subject of critical coverage by the publication Dallas Express, which Bennett had started in 2021 to remedy what he saw as liberal bias in local news reporting. The dispute settled in 2024 when Blackwell's agreed to support Bennett's continued management, and Braemar reimbursed Blackwell's for $7 million in costs and gave the firm a below-market rate loan to buy Braemar shares. Blackwell's and Antaby didn't respond to queries from Barron's. The Blackwell settlement disappointed other investors, including the billionaire Wafik Saeed, whose Al Shams investment firm is Braemar's largest outside shareholder, with 9.5% of the stock. In a securities filing, Saeed attached a July 2024 email to Bennett in which Saeed called the settlement a payoff. "The current state of Braemar looks dark," wrote Saeed in another email that appeared in a November 2024 securities filing. Braemar was diverting enormous resources to the advisory company of its board chairman, Bennett, the email continued. Saeed called on the REIT to appoint truly independent directors, end Bennett's management contract, and renegotiate its termination fee. Other shareholders unhappy with the Ashford contracts included the family office of Bob Gassamia, Los Angeles real estate investors who had a 7.5% stake in Braemar after selling the REIT a hotel. When Gassamia complained about the contracts and Braemar's governance, the REIT put him on the board in August of 2025. Later that day, Braemar announced it was putting itself up for sale, with a $505 million termination fee payable to Ashford when it happens. In securities filings, Gassamia says he was blindsided by the announcement. An earlier report by Deutsche Bank had projected a termination fee of $200 million, while Baird, which had been Braemar's investment bank, had projected $283 million. Braemar kicked Gassamia off its board in February, saying he had violated his standstill agreement with the company. Gassamia denied the claim and, in a letter to Braemar attached to a federal court filing, said Braemar had offered to sell Saeed a hotel in exchange for his shares when Saeed threatened a lawsuit. With the $505 million termination fee hanging over any transaction, no acquisition deal has been announced in the 6 months since Braemar hung a for-sale sign. Knowledgeable people tell Barron's that some large real estate investors considered bidding, but concluded Braemar shareholders wouldn't approve a deal that triggered the termination fee. Securities filings show shareholder letters critiquing the termination fee from Zazovi Associates and from Alejandro Malbrand's investment firm, Brancusi, which owns about 1% of Braemar stock. On March 11th, the REIT sued Malbrand and Gassamia in a federal court in Maryland. Citing their criticism of Bennett's contract, the suit alleges that they violated securities laws by forming a secret group, quote-unquote, to interfere with Braemar's sale. Gassamia's motion to dismiss stated that Braemar produced no evidence that its critics collaborated. Since the company's sale didn't happen, Braemar is now taking bids on individual hotels, with interest from some of the same firms that took a pass on the company last year, according to a person knowledgeable about the process. A December amendment to the advisory contract says that if half of Braemar's assets get sold, the termination payment still triggers. Bennett tells Barron's that he's working hard for the REITs. "We remain focused on driving long-term value for shareholders," he says. The next article, something very much in the news these days: how to get out of a private credit fund. Some fund managers are limiting redemptions amid growing worries about the asset class, but there are ways to exit a quote-unquote gated fund, by Amy Stone. A handful of private credit funds offered by companies including BlackRock, Apollo Global Management, and Ares Capital have recently limited investor redemptions, and investors who find themselves stuck in the funds aren't too happy. Many funds that hold illiquid assets, such as private credit, allow investors to cash out only once a quarter, and if total requests reach more than 5 to 7% of assets, will only fill a portion of each request. The thinking is that those provisions protect the fund's remaining investors from a rush to the exits that would force managers to sell underlying securities at fire sale prices. There's nearly $5 billion in assets in such gated funds that investors would like to withdraw, Bloomberg estimates. And more investors are likely to try to pull money out of these funds now that the economy is weakening and default rates are climbing. Investors stuck in a gated fund may be able to get their money out using other methods, however. Here are some techniques that financial advisors suggest exploring. Look for workarounds. Requesting required minimum distributions, or RMDs, may be a good option for investors who hold these funds in an individual retirement account and are over age 73, says Jeffrey L. Stock Jr. of Tenet Wealth Management, a member of the Advisory Services Network. RMDs are required by law, and asset managers generally need to honor those requests. Stock says he's used this method successfully with new clients who came to him holding gated funds that he didn't consider suitable for their goals. Other provisions may allow for exits when a client has run out of money and requires government assistance, or when the owner of the position has died, Stock says. Investors should check fund documentation carefully. Another way, find a buyer. There may be ways to sell private credit funds, but investors should expect to receive a sizable discount to net asset value if they sell now, says Kurt Nye, Chief Investment Officer at MAI Capital Management. To get a sense of the likely discount, consider that publicly traded business development companies are trading at about a 20% discount to NAV. Or this. Hedge fund manager Boaz Weinstein is currently offering as little as 65 cents on the dollar for stakes in certain private credit funds managed by Blue Owl Capital, an asset manager specializing in private funds. Still, for someone who really needs the money, a sale may be worth exploring. For clients of wealth managers, more so-called liquidity providers have emerged as this channel has grown. Alternative investment platform iCapital works with a company called Tangible Markets to create a secondary market where advisors and their clients can buy and sell shares of private market funds. Other firms establishing similar businesses include Ben, which operates the trustben.com website, and Moonfair. What about secondaries? This term usually refers to institutional investors, such as pension funds, selling large stakes to other institutional investors on the secondary market. Advisors with ultra-high net worth clients or large pooled positions of $5 million or $10 million may be able to take part. There's not much in the $150,000 to $200,000 range, says Joe DeGrossa, CEO of Access Capital and co-author of the Financial Advisor's Guide to Private Investments. It's important to monitor these developments closely and evaluate secondary sale opportunities accordingly, says Ted Neild, CEO and Chief Investment Officer of Chicago-based Gresham Partners. Portfolio level fixes. Some advisors look to invest in sectors that will do well precisely when another one is doing badly. For example, says DeGrossa, when credit defaults rise, that may be a good time to consider investing in distressed credit, sometimes referred to as opportunistic credit. Good managers here can capitalize on this market dislocation, he says. Shorting is rarely a good idea for most investors, but Goldman Sachs Group and JP Morgan Chase have come up with ways to allow hedge fund clients to bet against the private credit space, Bloomberg reports. Nevertheless, investors should be careful about buying another illiquid vehicle to compensate for being stuck in one, warns Stephen Tuckwood, Director of Investments at Modern Wealth Management. He calls this a liquidity stack error. Once a position is gated, focus on rebuilding true liquidity elsewhere in the portfolio, he says. Do not compound the issue by reallocating into other semi-liquid strategies as substitutes, particularly those with similar asset and redemption profiles. If stuck in an illiquid fund, Stock says he'll work to limit exposure to the same kind of risk in publicly traded parts of a portfolio. For example, he may reduce high yield or bank loan allocations if a client is stuck in private credit. We'll adjust the publicly traded allocation to get 100% of the asset class exposure that we're looking for, he says. Prod the fund manager to do better. Private credit fund managers may have options that can improve outcomes for their investors, Writes Barron's Andrew Barry, cutting fees is a good example for starters. They can also find ways to meet more redemption requests and perhaps return capital to investors, quote-unquote, in kind. Financial advisors may have some leverage with fund managers, particularly if their clients have a lot of assets at the firm. Join or form an investor committee, says Jordan Waxman, founder and managing partner at Nucleus Advisors. A really troubled fund could close and return capital to investors at NAV. Collective pressure may help to distribute or wind down fund assets, he says. And finally, pursue legal recourse. Investors who see signs of fraud or a breach of terms and have sizable positions may want to consider legal action. Options, says Waxman, including filing a legal claim or a complaint with a regulatory authority or demanding mediation or arbitration, especially if there are proven damages from the gating action, he says. In most cases, investors are better off financially using other methods, says Stock, including gradually getting out of prorated funds over time. He advises requesting redemptions every quarter and early in the window until the position is fully exited. But that could take time. Issues in private credit are just emerging. As Neild says, historically, gates tend to last longer than most expect. Editorial note, Steve Garmhausen contributed to that article. The cover story, Elon's empire will start its many, many thousands of words. I don't know how far we'll get into it, but we will start it. The SpaceX IPO is just the beginning. Musk may merge all his companies into one, by Al Rote. SpaceX's initial public offering may be the biggest ever, but it might just be a prelude to the largest merger ever, a combination of Tesla with Elon Musk's space venture. On April 1st, SpaceX reportedly filed confidentially for an IPO. It's likely to raise $75 billion, more than double the $29 billion that Saudi Aramco raised in 2019, 3 times the $25 billion that Alibaba Group Holding raised in 2014. Its valuation could come in close to $2 trillion, immediately making the company the 6th most valuable in the U.S. Not bad for a venture that was worth only $350 billion a year ago and was founded by a 30-year-old who thought it was dumb to dispose of rockets as if they were plastic straws. SpaceX's IPO would be remarkable on its own, but it might only be the first step in a process Musk calls convergence, the act of combining all of his companies into one, and that process is well underway. Just 2 months ago, SpaceX merged with Musk's xAI in a deal that valued the ex-parent at $250 billion. Combination of Tesla and SpaceX to create a $3.5 trillion behemoth would yield an AI-infused industrial mega-conglomerate that would instantly become one of the most valuable companies in the world and the premier manufacturing company on the planet. I think it's probable, says Baird analyst Ben Callow. It looks like that's going to happen. No matter what happens, the SpaceX IPO is coming first, and it's the better business. Yes, it could help rescue Tesla, whose shares have fallen almost 30% after hitting a record high in December, from its current stagnation. But for now, investors may be better off focusing on SpaceX and holding off on buying both stocks. SpaceX is already staggeringly successful and has a knack for making others in the industry look a little foolish. It took only 6 years from its founding in 2002 for SpaceX to become the first privately funded organization to put a liquid-fueled rocket into orbit. Few understood exactly what was happening. In 2015, SpaceX President Gwynne Shotwell was chided in Congress about how her company could afford to offer launches at a price far below the $400 million of America's dominant commercial launch provider, ULA, which is a 50-50 joint venture between Boeing and Lockheed Martin. "It's hard for me to say," she replied. "I don't know how to build a $400 million rocket." By 2017, SpaceX was reusing rockets, dramatically lowering the cost to reach orbit. More recently, SpaceX posted a picture of its improved Raptor rocket engines, leading Tori Bruno, at the time the head of ULA, to comment that there was no need to exaggerate SpaceX's tech by showing partially assembled engines. SpaceX responded by posting a video of the engine running. "Works pretty good for a partially assembled engine," said Shotwell. The tech, which integrated cooling and sensors inside components, appeared almost magical, even to industry insiders. Investors have to put a multiple on that magic when SpaceX goes public. Currently worth $1.25 trillion after the XAI merger, SpaceX will be aiming for a valuation of up to $2 trillion, or roughly 75 times estimated 2026 sales and 160 times estimated earnings before EBITDA. It's an eye-popping valuation, and not one that lends itself to comparison. Cost advantage from reusable rockets. It also built Starlink, a profitable space-based broadband project, which had more than 9 million subscribers at the end of 2025, up roughly 100% year over year, with each paying at least $600 a year for the service. SpaceX is a cash machine, says Rainmaker Securities Managing Director Greg Martin, who believes SpaceX's EBITDA profit margins were as high as 50% before the XAI merger. For SpaceX's valuation to make any kind of sense, the company will have to keep those margins high as it grows, and that means making it even cheaper to go to space. SpaceX's partially reusable Falcon 9 costs an estimated $2,000 to $3,000 per kilogram to reach low Earth orbit, 1/20th the cost relative to the space shuttle. SpaceX's huge, fully reusable Starship could cut costs relative to Falcon by another 80 to 90%. Musk's big bet with SpaceX is on space-based data centers, which he believes could be cheaper to operate than terrestrial ones in 2 to 3 years, even if they're more expensive to build. Musk spent an estimated $3 billion to $4 billion on XAI's Colossus 1 data center, equipped with 100,000 NVIDIA H100 graphics processing units in Memphis. Right now, SpaceX might require 1,000 satellites and 100 launches to put that number in space, which could cost double that amount. With Starship, however, the number of flights to build the equivalent data center gets cut by 75%, and the total cost might be only 20% higher. The savings from running the space-based data centers would be enormous. SpaceX would have a $200 million annual power bill to run Colossus, as XAI does, and there would be no Memphis residents complaining about the hum or impact on water prices. With additional satellite, chip, rocket, and cooling work, plus rising costs for terrestrial power and construction, it isn't hard to imagine a world where it's more cost-effective to build in space. And it would be big business if successful. OpenAI is spending $60 billion a year with Oracle for 4.5 gigawatts of compute capacity. Musk wants to put 100 gigawatts into space. That's $1.3 trillion in annual compute sales based on Oracle's metrics. For SpaceX, success could mean the difference between an astronomical valuation and something far lower. If orbital data centers aren't a thing, that's definitely a valuation drag, says Martin, and if they are a thing, it's a $10 trillion company. And with that, we've come to the end of our reading of Barron's for April 13th of 2026. This is your reader, Eric, saying be well, be safe, look after each other. Bye for now.